Hello, everyone. Welcome to this exciting panel discussion. Over the next 30 minutes, we will discuss the market outlook for 2025 and we will analyze the opportunities for investors in a changing world. And for that, we have our two CIOs with us today, Gerard Albà, CIO of MoraBanc, and Fernando de Frutos, CIO of Boreal Capital Management. They will share their vision on the very interesting times we are living in. The year started with some key events that are inevitably having an impact on the global economy. On the one hand, we have seen Donald Trump returning to the presidency of the United States. This has caused great uncertainty and has had a direct impact on international policies, especially through the trade wars. On the other hand, the financial markets remain at near all-time highs, driven by the rapid advance of artificial intelligence and other disruptive technologies. This scenario creates unique opportunities and challenges that encourage us to reflect on how to position ourselves strategically to capture all this potential. After this 30 minutes discussion, we will also have 15 more minutes where our experts will be answering any questions from the audience. Please feel free to send us your question using the option available in the application. And we start now with Gerard Albà. Hola, Gerard. First of all, thanks for your presence today in this panel discussion. And we would like you to start commenting what is the current state of the global growth, the global economy. How do you see the growth, and what are the potential of this current environment that you are living in?
Thank you, Rafa, and welcome, and thanks to everyone. So overall, on the macro side, we think that global growth will continue stable. Inflation will keep moderating, and central banks will also keep lowering rates over the next future. So the macro backdrop, we think, is good for financial markets. Said that there's an important, a big divergence, a big difference between the growth in the US and the rest, in Europe and China. We think US will keep with a solid growth of around 2.5% with the support of the good conditions of the labor market and also consumers in a good position. Consumers are like 65% of US economy, and I think it's in good shape. On the other hand, in Europe, where we are, growth is much more weaker. We expect growth to be around 0.8% with different tailwinds. On one hand, in Europe, we have more short-term cyclical issues, but we also face some more long-term structural issues on growth. On the structural side, on one hand, we have the loss of competitiveness of Europe in the global trade, mainly against China. We also have higher costs of energy, and all of this affects a lot many sectors of the European economy, like traditional industrials, metals, paper, autos, and several sectors. On the more cyclical side, of course, Europe is facing the news or the challenges of the new policies of tariffs that could apply also to the European economy. And on the other hand, Europe does not have a strong technology sector that could benefit, like, for example, the US is doing, or others from the AI developments. Also inside Europe, we see many differences. Southern Europe countries, Portugal, Spain, Italy, or even Greece, are in a much better position because their economies are less exposed to tariffs, are economies based on services sector. And on the other hand, core European countries are more on strict fiscal policy mode that lacks the needed economical stimulus. Said that, we also think that last weekend elections in Germany and the final results make us be more positive in terms of financial stability in Europe. In Europe as well, on the business and corporate side, we see encouraging positive trends in terms of earnings growth, and these together with lower valuations make us think that what we've seen recently at the beginning of the year of a good performance of the European markets could have some additional legs.
Thank you very much, Gerard. So, summarizing, this solid growth in the US on the one side, and then Europe is closing a little bit the gap to be or to have a bit more of positive growth in the coming month. Fernando, now it's your turn. How do you see and what is the possible repercussion of this geopolitical instability? For especially for global markets, for investment strategies for our clients.
Yes, thank you, Rafa. Definitely in the US, we have in the short term pro-growth policies that will help. The big issue is whether also some of these policies will be at the expense of the growth of other countries because of tariffs and the like. So there's this macro uncertainty, but so far financial markets have been focusing much more on the micro. They have been on standby, mostly because some of the announcements concerning tariffs, we have seen there has been an announcement and a counter announcement. And in the end, the markets they see, and we all perceive it's a part of negotiation tactic, part is broader than economic issues, is immigration also mixed with tariffs. So markets are waiting for the dust to settle, and definitely then it can have an impact. We need to remember what happened in 2018 when the trade war with China started, and and Trump started to get into a confrontational stance against China. China retaliated, and we had the S&P 500 correcting almost 20% for the last months of 2018. Back then, we saw that Trump, probably the main indicator that he sees of success is the level of the S&P 500, and now they are also including to that mix where the 10-year US Treasury yield is. So markets will also play a role in keeping the administration in check. So far, very much focused on earnings. We will elaborate on valuations for sure. They have been much more focused on positive earnings growth, which also looping in with Gerard on Europe and beyond the US, we have seen also earnings growth beyond the US, and that's also supports the macro. Then we have seen the volatility, the VIX index trading at very, modest levels, not really showing signs of stress. Corporate spreads also not widening. Overall, we would see its markets are calmed and expecting. Probably the only asset that is reflecting some of this macro uncertainty and geopolitical uncertainty is gold, which has been rallying last year, probably recovering what did not do during 2022 and 23 when we had high inflation and didn't capture that into the price. And we are seeing now over the last months an acceleration. That's probably the only asset that is showing some kind of direct impact of macroeconomic or geopolitical uncertainty.
So it seems that the uncertainty will be the constant in the coming years, and possibly the market are not totally reflecting this uncertainty with low volatility, as Fernando mentioned, and the level of spreads are in a very low level. But we're coming to Europe, where Gerard sits, and Gerard, please, could you please elaborate a little bit on political developments and how all the tariffs are going to impact in Europe?
Yes, I mean, of course, currently the main risk in the economy or even in the financial markets are tariffs and uncertainty about the final implementation of those. Tariffs, of course, uh, will have or could have uh, two main impacts, no? On growth, of course, because you take money out, it's like a tax on consumers and also on businesses and companies, but because the uncertainty around investments of capex investing. So for sure, tariffs would have an impact on growth. In Europe, so far, tariffs seem that could be more limited, more constrained to some specific sectors like autos. Said that estimates said that tariffs could even globally impact GDP figures around 1%. So it's a relevant factor. And we think if finally we have like a hard version of tariffs, that could mean in Europe that the central bank should, later we can discuss about central banks and interest rate levels. But I think that could be an important factor weakening even more European economy and making the for sure forthcoming European Central Bank rate cuts being more accelerated. Said that, of course, tariffs also have affectations on inflation. I think those are more one-offs effect. And overall, the general impact of tariffs is going to be probably more felt in emerging economies, which are even more exposed to global trade, especially China.
Thank you, Gerard. So now let's go to analyze the valuations. As we mentioned at the beginning, the markets are currently in all-time highs. Europe has already recovered the level that it has 25 years ago. It took 25 years to Europe to recover the level. And I would like Fernando to help us a little bit analyze how are those valuations and how can we help our clients and investors navigate and how to invest in this kind of high valuated markets?
Definitely, valuations are the elephant in the room, although there are differences between the US and Europe. Probably Gerard can later elaborate on that. In the US, we are talking about very high price earnings multiples, very low equity risk premiums, which imply that compared to bonds, equities are very expensive. But you need to think about valuations as a static picture of a company. We know that we invest on equities because of growth, earnings growth. So cheap or expensive today based on a multiple can look completely different 10 years later when the company has grown or not grown earnings. So earnings growth dominates equities. We are at a phase where it's no longer so easy as it has been over the past decade and a half, when we had very, very cheap valuations and it was relatively easy to invest on equities because you saw that there was almost compared to a bond, treated equities to a bond was attractive. Now we are getting into the more difficult area, which is the normal regime, where you need to is much more about assessing growth. And here you can have excesses, as happened during the dot-com crisis, dot-com bubble, or you can have really very good markets where you pay high multiples, but these multiples are later validated by very high earnings down the road. So where we are today is a big, basically we are at the crossroads. We need to think let's look at earnings, let's step back. We have seen very solid earnings growth. You said before, Rafa, that indices were at all-time highs or near all-time highs, but corporate earnings are also near all-time highs. So the question is, that prices have been rising faster than earnings, but earnings have been rising. So you have support in valuations by earnings growth. The S&P has closed the year with almost the fourth quarter earnings season finished with a 10% increase year-on-year earnings. Last quarter was 16%. So we see a strong growth, which correlates to a stronger economy, as Gerard exposed before. So that's a positive, net positive. Then you have the issue of valuations has to do also with where interest rates are, and we will elaborate on that. And there is a high chance that in the next years, we may see interest rates much lower. We have seen how when the Fed had to help the economy, help growth, they have done so, and they have done so in a very resolutive way, so lowering rates so very fast. So you could think that this famous Fed put, as it's called, this safety net that you have, that the Fed has ample room, a lot of dry powder for helping markets and helping the economy. It's giving you some comfort when you are investing at all-time highs. But definitely, it's about earnings, it's about growth in the US, and we will touch upon you mentioned at the beginning AI. Okay, how AI is monetized and transforms into higher corporate earnings, higher productivity down the road.
Thank you, Fernando. So in contrast with these US markets, very heavy in technology indices, we have Europe. And I would like you, Gerard, to help us elaborate a little bit. How is Europe, Japan mirroring this heavy technologies index in the US?
Yeah, sure. Yes, I agree. I mean, the macro backdrop is, generally speaking, solid growth and lower rates. I think good for equities. Said that, of course, the 20-25% rallies that we saw in the US market probably are unlikely to repeat over the next years. And as Fernando said, it's more about earnings growth than multiple expansion going forward. No, US is in a good shape, so probably 10% earnings increase are more the normal going forward. In Europe, the situation is quite different. Valuations in terms of earnings multiples are in a very different situation. I mean, if the S&P 500 in the US is around 22 times earnings, or 19 times excluding big technology companies. In Europe, even lacking that technology strong sector, if we compare sector by sector, the earnings multiples at which the European companies of the same sector are trading, multiples are around 13%. Moreover, many of those companies have, of course, exposure and assets to the US, and I could say you could invest in those at a cheaper prices. And as Fernando also pointed out, it's important to look at it in terms of the equity risk premium. In Europe, in addition to low valuations of equities, you have lower interest rates, both in the short and in the long term buckets. So the premium of investing in equities is even more compelling. So I think that's a good, interesting opportunity if economy keeps with this, let's say, good backdrop behind.
Thank you. So I continue with you, Gerard. With all this high valuation, but despite the valuation, we continue seeing that this technology, artificial intelligence, and also new technologies that are just in the last year being megatrends, like blockchain, for example. What are the role that all these technologies can play in the future, and how can investors position themselves to capture the potential in this space?
Absolutely. Of course, AI stocks have performed extremely well over the last years. I would say that mainly AI infrastructure stocks to be more precise as technology is development. Those more companies about computational capacity hardware have been growing their earnings at very high levels, 30%. I think that's not going to be midterm sustainable. Probably they will grow more at 15% levels. Short term, it's true that we still see the large technology companies, the hyperscalers investing heavily. I think for this year, their expectations, their budgets are around 250 billion of investment in infrastructure. So the sector is in good shape, but I think the next wave of opportunity is going to be more on the application layer, no? On products using based on AI or benefiting from AI to the end client. As an example of that, of this kind of stocks, I think stocks like Uber, which are benefiting from AI, for example, in the autonomous vehicle space, I think they are going to be interesting sectors to analyze and probably with good investment opportunities. Also, DeepSeek, the Chinese DeepSeek event disruption in the sector has shown us that there are, of course, risk in investing in the sector and volatility. Also, that China probably could be at some point an interesting place where to look for AI investing opportunities. But of course, in the short term, because of their own crisis from the real estate leverage crisis, and also from the risk of the new tariffs from Trump's administration, I think it's still too early to think that Chinese AI could be an opportunity. On the blockchain digital assets, I think we are more in early stages. We, of course, see opportunities in digital assets or in tokens as use cases start to generate value for end clients, which, of course, is the key of a good business. But here, of course, there are many differences, again, between tokens, for example, a token to tokenize financial or real assets. It's a very different use case and value creation, for example, than Bitcoin as a reserve or a value transfer asset. At MoraBanc, especially at MoraBanc in Andorra, we've seen a lot of interest around, and we currently offer custody services of digital assets and some products like investment funds.
Thank you, Gerard. Fernando, maybe you can complement a little bit, and from a US perspective, especially comment a little bit on the threats from China, and if the US AI and the technology can still deliver an edge in this sense.
I would say being a technologist is even more difficult than an investment strategist. So knowing where technology will go is notoriously difficult. We, as investors, we can look back to parallels, like I alluded before, the .com. I think markets are adaptive and markets learn. Investors learned from the mistakes of the .com bubble. We don't see the excesses that we saw at the time. As Gerard mentioned, the interest on AI is focused now more on the plumbing infrastructure side of AI, the NVIDIAs. Although there is a cadre of companies, the large tech companies that are very well positioned to capture AI. I would say Meta is the company that has the market has recognized the investments in AI as being able to monetize them already, and others like Apple, Google, etc. These companies that have also other business models and other sources of revenue. So it's a very, very different case as compared to the dot-com that was everything brand new. There will be new companies entering the space. We need to remember Alphabet didn't exist in the year 2000. Apple was something used by basic graphic designers. It's impossible to think how all this is going to develop. But we as investors, definitely, we are witnessing a third digital revolution. So we had the era of computing, mainframes, then personal computers, internet, email, etc. Then we have Internet 2.0 with social media apps, and AI is a different animal, and we can see that is very powerful and it's going to be very transformative. And again, we need to be very alert to spot excesses of valuation and over optimism. We do not see that, but as Gerard mentioned, we also do not see a lot of use cases that are directly translating into higher earnings. But it's going to happen, and it's not going to take 10 years. This is going to happen in the next years. So who are going to be the next enablers, like the oracles, the SIPs that came with the ERP solutions for digitalizing companies? Are these companies going to transition to incorporate AI into their products? And this is going to be another incredible source of revenue, or is going to be a Salesforce or a new company that doesn't exist who is going to do that? Impossible to predict. Then on your point on leadership, yes, so far I would say US markets in general are showing leadership in terms of attracting talent, attracting capital, deep capital market, deep domestic market, and we know that innovation in the US, the US is a leader in innovation, but also we are witnessing a new technology, and there can be newcomers coming from different geographies. So we in a nutshell, tremendous opportunity, very difficult to know today where it's going to pay off, and we need to be very, very alert and to follow this space intensively.
Thank you, Fernando. Now, changing topic and changing asset class. In the recent years, we have seen that private markets have played an increasing role in financing companies, which has created new opportunities for investors. Gerard, it's your turn now. How do the risk and return profile of private market assets, so venture capital, private debt, infrastructure, as an example, compare, and how can investors diversify their portfolios across these asset classes?
Yeah, true. Private markets, as you said, have been playing even a more important role than public markets for the financing of businesses and companies, both on the debt and the equity side. I would add, in addition to that, that also the development of new fund products, evergreen, semi-liquid funds, has made the asset class much more accessible beyond the traditional institutional investing. And in the space, for example, private debt with different segments, direct lending, but now also asset-backed financing. Those kind of assets are currently offering even a pickup compared to similar levels, similar credit risk levels of traditional bonds in the high yield space. So if liquidity is not a concern for an investor, the Sharpe ratio, this combination of return versus risk of the asset class, I think makes plenty of sense. And of course, it's a good contribution in diversifying more traditional asset portfolios. At MoraBanc, we have been also recently investing in private infrastructure funds, where we think there's also currently a good opportunity because of those of some of those global trends that we've been discussing. There are capital needs in different business areas or activities. For example, in digital infrastructure that we already discussed, data centers, but also in energy transition, renewables, also in other global social trends like demography, the aging of the population creates the need of new services and products with the need of capital. So that's again an opportunity for investors.
Yeah, absolutely, Gerard. In the last year, private markets have been a source opportunity for investors to diversify their portfolio and get a higher yield in some of the asset classes. Maybe Fernando can also help us and can complement a little bit on Gerard's answer, especially on platforms facilitating access to our clients to this spectrum.
Yes, this asset class has been undergoing a tremendous, say, transformation at product level. As Gerard mentioned, the advent of evergreen, semi-liquid alternatives has transformed the natural demand for this asset class, which was more limited to pension funds, large family offices. Not only that, but in the US, and it's also spreading to Europe now. You are also part of that, Rafa, in Switzerland. We have seen the advent of platforms like iCapital, which are serving different purposes for democratizing this asset class for wealth management, for private banking, because they are offering access to top-tier providers, top-tier investment funds. We don't need to promote any particular one, but the big names in the industry, the KKRs, the Blackstones, etc., which required, if you want to access directly, several million investments for getting into the fund. Now they are offering feeder funds where you can access these funds. On top of that, you get a due diligence report for those funds, something that even for a firm like us, doing a proper professional due diligence is quite an endeavor, and you need to have quite unique skills to do that, so that you cannot do it for every product. You need to limit a lot to certain products, as the ones that Gerard was mentioning. You can just choose some, but not have access to 40, 50 funds. And so these two factors are allowing now wealth managers, particularly here in the US where it started. So these platforms were created by the large fund providers, the Blackstones, the BlackRocks, etc., just to expand the demand to wealth management. And it's been part of regular wealth management portfolios because you don't have the liquidity constraints, and you have access to safe access to the asset class. Another trend that I just mentioning on valuations, Gerard commented the success of private credit. Private debt has been taking a lot of market share from traditional, say, high yield bonds. Private equity has been less demanded, and it also, circling back to Gerard's comment on the extraordinary performance of public markets over the past years. So that has been, say, investors have not been so keen on private equity when you had all this, the S&P having this high double-digit return for several years. But it may come also if we have more choppy markets. So that's an asset class. It's interesting to have the possibility to access to private real estate, private equity, private credit in an investor friendly way and safe way from the point of view of due diligence.
Thank you, Fernando. Let's move now to the monetary policy. In the last years, the central banks have been capturing most of the attention and actually have been one of the main drivers for markets. I would like Gerard to develop a little bit. How do we see now the central banks across most of the economies are starting to cut rates? The European Central Bank started last June. The Fed started with this jumbo cut in September. How do we see the monetary policies developing in the coming months?
Yeah, I think from here, the Fed will wait because basically there's no need to cut rates right now because of the macro backdrop in the US that we just discussed. So I think the Fed will wait until, let's say, the final uh, assessment or implementation of tariffs is done. Said that, I think throughout the year, it would make sense to see to cut rates. I mean, lowering from 4.5 current rate to 4 at the end of the by the end of the year, if as expected inflation continues to moderate. I think that would make sense. In Europe, as we said, the expectations of the situation is quite different. We expect the ECB to keep cutting rates, to cut 75 basis points from moving from 275 to 2%. Or even more, it could be even 100 basis points, because basically, as we already discussed, inflation is more controlled at 2.5%, and growth is much weaker. From my point of view, ECB's Lagarde's 2% neutral rate is a good guess, is a good equilibrium level for the coming years for the euro.
Thank you very much, Gerard. With this answer, we have to close the panel discussions, and we just start with the questions from the audience that actually we have received quite a number. I'm not sure if we're going to have time to answer all of them, but I will start with this question. After the first 2 months of 2025, how could they influence the rest of the year in global markets? It's two parts of a question, and I will start with Fernando. The first part of the question is, can we expect negative stock performance in the US for 2025? He already answered part of it, but I would like Fernando to develop a little bit more. And then the second part of the question will be for Gerard. Is Europe started strong during this period? Will this be a trend that continues throughout the year, or will we see a correction? Fernando, you start.
Honestly, I don't know. That's the answer. On a one-year basis, we cannot say. I would say, and it's not that I want to give back like a political type of, or politician type of answer. It's that you need to invest on equities on the longer run, say at least 5 years. Yes, valuations are high, opportunities are high. The opportunity cost of not being invested on equities with the transformation that we are seeing is very high. There are always risks. There are always geopolitical risks. There can be, we had bad consumer sentiment, consumer confidence data yesterday. We had a sell-off in the markets. We can have sell-offs for a variety of reasons. We have the safety net of the Fed. We have very good growth prospects. Definitely not time to get out of the market just by gut feeling that could be a good or bad year. I would say fundamentals, growth, and at micro level, innovation, I see more an opportunity cost regardless of the performance for 2025.
So Gerard, now.
Yeah, maybe me, on Europe, I think taking your comment, that Euro stocks is basically at the same 5,000 level that many years ago, early 2000s, what I think explains this, or it could be different this time, I mean, one of the reasons of the bad performance of European stocks if you invested in early 2000s or at those levels many years ago that we are now back, was that valuations were, multiples of valuation were very demanding, were double digit. I mean, 30, earnings ratios or multiples of 30 times was quite common among large European companies at that time. And of course, earnings have not grown like what we've seen in the US technology or in the US economy in general. So one of the reasons of the bad performance was because of high multiples at that time. So now we are at the same level, but multiples that we already discussed, 13 times earnings on average for the European stock market, I think makes like a safety net when investing. So I think the prospects or if the so far good performance of the European market this year could keep going. Again, as Fernando said, I don't know in the short term, but long term, I'm quite sure that there are many good opportunities in the European markets.
Thank you very much. So the aim is always to invest in a mid to long term, as we have been listening to Fernando and Gerard,
but,
because in the short
but
terms,
not 24 years waiting for.
Next question, Fernando. This is maybe for you. What are the biggest mistake investor can make in uncertain economic times, and how can they be avoided?
Well, that's a very good question. The only way to avoid it is to have discipline, and that's actually when we meet, and you, Rafa, have been with me together with many clients. When we meet with a new client, we say where we can really help is in bringing discipline to investing. And that seems very easy ex ante when one looks at the performance of the S&P, looks back and say, well, you had all these crises. You just simply need to stay put and just the market will recover. Well, it's not so easy. You need to have the discipline to remain investing. As we are saying now, markets are in all-time highs. Say psychology will tell you maybe you need to get out and realize profits, but you need to look also at corporate earnings, at opportunities. So you need to keep rational, as much rational as we can be as investors. And just the other part is diversification. It's very likely that you will recover your money if you invest in the S&P and stay invested and hold. If you just buy stocks, single stocks, and they are the wrong ones, and you stay invested, some stocks will never recover the value they had. Still, say, to give a name, many of the banks that like UBS in 2008 were trading at 4 times the level they are trading now, and very likely I will not see it trading at that level in my life. So not everything goes up after a correction, so you need to keep diversified and stay disciplined, and not to also overreact to macro news. 2020 is a very good example of that, when investors who got out in the panic of the pandemic in March the year 2000, they lost a year where the indexes closed with a positive performance, and then followed by another year that few people foresaw that was also very, very positive. So it's you need to have this discipline.
Thank you, Fernando. Now I have an interesting question that I'm sure it's a question that all attendees would like to know. So which alternative asset classes look more attractive this year? And I would like to hear the opinion of both of you. So Gerard, maybe we start with you.
Alternatives. Well, we discussed private markets. I think currently are good opportunities in the private markets compared to let's say public markets, where, as we already just touched, valuations can be quite demanding. Also, not only in equities that we talk more about, but also in credit and corporate bonds, where spreads are quite tight in terms of historical levels. So I think in private markets are still pockets of value. I think different opportunities. And also, that's maybe a different one, which is probably not the most popular, no? But in liquid alternatives, in hedge funds, I think we had a very bad experience years ago, no? For the reasons we all know. But I think currently the industry, as an alternative asset, has a quite different investment strategy in terms of risk return profile and how those organizations work. And I think there could be some additional ideas to include in a, of course, always diversified portfolio.
Thank you, Gerard. Now you, Fernando, what would be your pick in alternative asset classes?
Well, at Boreal, we are heavy users of derivatives in the portfolios. We like the asymmetric payoffs that they provide. At the moment, so we use derivatives for two main purposes: for hedging and for harnessing volatility. So kind of selling insurance against market. At the moment, with all the uncertainty that we have, and as I mentioned before, not translated into volatility in the market, harnessing volatility is not as interesting as buying volatility. So we can think we have markets at all-time highs. You want to be dancing as long as the music is playing, but you are concerned about valuations. You have the possibility of participating fully on the upside and getting very cheap protection against a bear market down the road. That's because of where volatility is. So that will be my pick for the year.
And
Thank you very much.
If I may, a couple of two additional alternatives that come to my mind. I think on the more traditional fixed income, in mortgages, mortgage-backed securities, I still think there's a nice pickup in yield. Another one could be in the insurance world, insurance-linked securities. I think the reinsurance world, because several catastrophic events taking place, it's in a hardening mode. So prices of the reinsurance market are attractive, and those through insurance-linked securities are a way to capture those also attractive yields for that diversifying risk.
Here at Boreal, we have enough exposure to natural disasters through the hurricane season, so we don't want to add more to the portfolios. We want to sleep quietly.
Unfortunately, time is limited and we need to finish this webinar. I would like to firstly thank Fernando and Gerard for your presence today, for your valuable insights and opinion. And mostly and foremost, I would like to thank all of the attendees. Thank you for assisting to this interesting webinar and this panel discussion. And we hope to see you in the next webinar that we will be scheduling for the next months. We will keep you informed for the next development. Thank you very much, and have a good rest of the day.
Thank you. Have a good day.
Thank you, Rafa. Thank you, everyone.